Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang. All right, the question today, will more S-Reits soon exit the local market? We've got Frasers Hospitality Trust looking to go private to unlock value for investors. Paragon Reit also doing it to facilitate a major AEI or asset enhancement initiative at its flagship property. So is this going to pave the way for more? And what do we make of Frasers Hospitality Trust's offer? Let's check in now with Alvin Chow. He is the CEO of Dr. Wealth. Good morning, Alvin. How are you doing these days?
Good morning, Ryan. Thanks for having me.
Okay, let's start first with what's on the table with FHT. They have done a bit of a strategic review of what to do, and they've kind of cited a couple of things. A worsening macroeconomic environment, a weaker foreign exchange rate against Singapore dollar, a higher interest rate environment. So a couple of factors there which they say make it more difficult for them to grow their distribution and net asset value. So they are thinking, hey, the best way to go about it now is to go private. And it's also the second time in 3 years they are going to try. What do you make of their rationale, and do you agree with all the reasons they've cited?
I definitely agree with the macroeconomic conditions or the challenges that the REITs are facing, as they have pointed out. It's just that I don't think that these reasons warrant a delisting, because most other REITs are facing the same problem, and we don't see there is an en masse kind of privatization going on among the REITs. Yes, we may have just one more case, which is Paragon Reit, but that's for another reason, right? It's not due to these macroeconomic conditions. So I don't think that these reasons, even though they exist, are the real cause of the delisting.
Yeah, there seems to be some urgency for them to do so because it's the second offer in 3 years. On the surface, it doesn't look like it's very different. How much do you like this offer?
I do like the offer though, because it is at least 11% above the net asset value, right? Which the net asset value essentially is the combined valuation of the properties net of the liabilities. So that means that investors are getting a higher price than essentially the valuation of properties, if we can look at it that way. And therefore, it's a good chance for investors to exit for a gain, right? Considering that hospitality trusts on whole did not do well. This year they are down. Like some even down more than 10% this year so far. So I do think that the macroeconomic challenges did weigh down this hospitality trust performance as well as their share prices. So having this offer, what I like about it is at least you get it above the valuation.
All right, maybe take a step back and talk to us about how Frasers Hospitality has been doing as a company, because we've been seeing tourism on the up, so I imagine they've been doing okay.
For the Frasers Hospitality, they have a lot of properties all around the world, and it's not equal in terms of their performances. And one of the reasons cited was the Forex, right? And this year we did see there's a major depreciation of the US dollar against Sing dollar. Right, and this indeed stronger Sing dollar does impact the revenue when it's converted back to Sing, right? So it will be lower than what it appears to be. So therefore, I do think that even if this revenue has been climbing up, it may not be as good as what it is pre-COVID, right? So the full recovery may not have realized, and also the dividends would be lowered due to the higher interest rate that they need to pay to service the loans. So I think largely it's true because of all these challenges, it has been weighing down the performance.
Okay, so FHT owns hotels and service residences in Singapore, Malaysia, Australia, Japan, the UK and Germany. And for the 6 months ended March 31st, their net property income declined 2.5% from the year before because of all those factors you mentioned, including elevated property taxes, utility costs driven by inflation and other expenses. So to your point, yes, a bit of patchy performance in the past year. All right, let's take a look at the offer again. You talked about what you liked about it. What do you not like about it?
What I don't like is the comparison with the first offer. Right, so the first offer was at 70 cents and this second offer is at 71 cents. So it's a 1 cent increment. It's just that for some unit holders, they may see it as an insincere second offer because it's not a very significant jump from the last one. I would think that maybe, a 5 cents more, right, going to about 75 cents would be something that's definitely convincing, and that would really quite successfully, I would say, bring the privatization to order.
Okay, so where do you think this is going to go? Because price, like you point out, on the surface is just marginally higher. Do you think it needs to be sweetened anymore? And do you think there's enough here for shareholders to be convinced?
Generally, I believe it is going to go through, right? Considering the first offer, they did manage to garner that 74.88% votes for the privatization, and it's just shy of that 75% mark. So I do think that it is close, right? And considering that the Hospitality Trust share price haven't been doing well since the first offer, right? So that means that this is a second chance for them to realize that gain, right? With just a slightly more, 1 cent more per unit offer. Right, so I do think that there is a high chance that they may succeed this time around.
Okay, now it's time to take a step back and talk about delistings. So FHT potentially is going to be one of them. At least 16 companies are on track to do so as of the first week of May. What do you make of what's going on here? It's starting to look like a trend going on.
Definitely, the listing trend has been ongoing for many, many years, and this year as well. So really, the task force that's looking into this matter would need to be quick about rolling out all the initiatives, right, to encourage more companies to stay listed. But in the space of REITs, I would say that REITs benefit from this capital markets more than other kinds of companies. One reason is because for REITs, they usually distribute most of their rental income as dividends, right? So they keep very little capital within the company. And when they want to expand and buy a property, they usually would need to tap on funds, right? And they are also capped or limited by the amount of loans that they can take due to the gearing ratio limit of 50%. So therefore, they would always need to tap the capital markets to raise money to buy the capital-intensive properties. So therefore, I think that for REITs, there is a lot more benefits, right, to stay listed and tap on this market as opposed to other companies where they don't intend to raise more equity, and therefore when the prices are not really encouraging, not very popular in the markets, they may just decide to delist. And I think those companies have the reasons to do so, right? But REITs will be less so. So I don't expect REITs to see widespread delisting in the near future.
All right, so it sounds like the stronger ones will be able to stay on while the weaker ones might be weeded out in a sense.
Definitely, yes. Right. So for the stronger ones, especially if they're trading above the NAV or close to NAV, net asset value in that sense, they would have no issues doing rights issues and things like this, right? Or even private placement that we have seen capital ascenders just recently do it for the acquisition of property. So all this will be well and good, right? On the other hand, the weaker ones, they may also find it hard to delist, right? Because the price may be way below the NAV, and it takes a lot more convincing for the unit holders to vote for delisting offer. So because of all these challenges, I do think that REITs will stay listed for quite a while.
All right, of course, many company-specific factors to weigh as well, including their undervaluation status, whether they think the cost of maintaining a listing is worth it, and much more. So a lot to balance on that front and help us to figure out where things are going when it comes to delistings, as well as a view on the latest effort by FHT to go private has been Alvin Chow. He is the CEO of Dr. Wealth. Alvin, thanks for your time this morning. Always great chatting with you.
Thanks, Ryan.
All right, we'll catch up with you again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.